might you think about long-term averages if you're an investor? Well, here to talk with me about that is David Shotwell. He's a financial planner with Shotwell, Rutter, and Baer Financial Planners. David, welcome.
Thanks, Bob. How are you today?
I'm great, and I'll be even better after you sort of walk us through how investors need to think about long-term averages.
Yeah. So in the investment world, we're bombarded with statistics, right? And it's pretty common for people to look at past performance and try to extrapolate different comparisons. And it's pretty common for clients, especially newer clients, to like look at a portfolio and see one thing's down, one thing's up. Why are we keeping, this? Why are we keeping that? And so what we try to do is help people think about like what can we learn from long-term returns? And first of all, if your portfolio is diversified, there's always going to be something that isn't performing as well as everything else. That's just the nature of diversification. What we like to do is frame up the conversation that if the market's been doing very well, your portfolio should be doing well too. And what's really important is to think about, okay, if my portfolio is up 12% this year, but a long-term average for a portfolio like mine is 8%, what does that tell us about the future, right? And if the long-term averages hold true, and they tend to hold true over time, right? That's the nature of how these things work, then we've got to expect some downside if we've seen outperformance for a while. And just trying to keep that in perspective.
Yeah. So when you think about investing, I think, I think about the historical averages and forgive me for jumping around a little bit, but I think about,
Sure.
for the long term, small cap stocks have done 12% on average since the late 1920s, and large cap have been done 10%.